Hi, you're watching ET Markets Live. I'm Neha Vashisht. Welcome to a brand new episode of ET World View, where we discuss everything global from markets to sectors and more here on ET. Today, I'm here with Mr. Abhishek Banerjee from Lotus Dew Wealth. Thank you so much, Abhishek, for taking out time and joining us today on ET Markets Live.
Thank you very much and glad to be here. Thanks for the opportunity.
Well, the pleasure is all mine. Let's start with world markets. A lot is happening in the markets right now. Rupee is at an all-time low. Silver and gold are near all-time highs. Dollar is firm, but let's start with India first. India's GDP jumped to 8.2%, but the stock markets barely moved. So, why didn't we see a stronger reaction in markets? What are your thoughts on that?
So first, let's understand, what was the expectation that was built into the market. If
Hmm.
you look at RBI's data, RBI on their website, they disclose something called Survey of Professional Forecasters. So these are usually banks like Citibank or JP Morgan and also Indian brokerages like MK and so on.
Hmm.
There's a cohort of specialists who they survey asking like what are your expectations with the GDP, and the range for the last forecast for Q2, which is the current GDP number that we got as 8.2, it ranged
Yeah.
from anywhere between 6.4 to 8.4%. So it was a 2% of delta between the most bearish and the most bullish. The data actually came in at around 8.2, which was
Hmm.
very much towards the higher end of the expectation. And usually what we see is that it's better to winterize or kind of disregard the extremes of the forecast, because many a times houses put out a very kind of headline catching number as a way to kind of get into the headlines, but the median is usually where the expectations are, and this time it was
Hmm.
far above the median. It was closer to the upper end of the forecast. So this is something which is usually never happens. This is something which is way beyond the expectation. But what was visible, for example, if you look at the GST data, the CM generated vehicle sales data, the trade numbers which are available at a higher frequency versus a GDP that was available once a quarter, the numbers kind of made sense, and it was already getting baked into the market price. So one of the reasons we don't see a very large reaction in the market today, so the number actually got disclosure by the government after market on Friday, so we had the weekend to digest all the numbers, and then today is the first day of live session after the numbers were given out. Barely the market's opened 0.5%, and since then the market has slid back. Firstly, the Asian markets are, for example, Japanese markets are down 2%. So there's a
Hmm.
pull beta, which means that other Asian markets are not doing as great as Indian markets today. So in the context of that, Indian markets holding steady is already good. But
Hmm.
also the fact that most of this good news was already priced in, right? And there was a little bit that got priced in because the numbers came out. But definitely, personally, I would have expected a better reaction to the market than we got today. I was expecting that we will actually scale to all-time highs, and it did touch all-time high, and then it has retraced back. I think definitely the concerns are still around what is going to happen with the MPC, RBI rate cut, which is due this week, as well as what's going to happen around the trade deals that are in the play, and other rising geopolitical tensions that always get factored in either through the monetary policy or through inflation. Those things have to be worked out. So those are some of the things that I think the markets are taking into stride.
Okay. Let's also talk about the US-India trade deal. There's very less progress, or maybe we can say no progress on the US-India trade deal end, and there are also rising tensions in coming from Venezuela also, which is oil exporter. So, do you think that inflation is a risk right now, and does this reduce the chances of an MPC rate cut at this point?
So, firstly, two things that are actually in the works in the winter session of the parliament. You have the India Pesticide Act and the India Seeds Act. So India Pesticides Act is already in public domain. India Seeds Act is being worked on. Just to put it in context of the trade deal, right? So obviously there is demand from US based agri producers to enable some sort of an agricultural play in India, and India has been thoroughly resisting that. We need to see what these acts do. These acts enable that somehow, and is there a truce that they have found, which is something which needs to be worked in. But however, if you look at the trade deal, it's definitely way more prolongated than the markets would have expected. There are, of course, packages being provided by the government for exporters in the form of credit guarantees and credit schemes. However, a lot of the export of India is also from unorganized sector, which are not listed. So it's hard to kind of see the impact of that into listed markets. For example, textile, basically 60% of exports of India, garments basically, and there are companies that are trying to diversify away from US markets and also trying to find new customers in Indian markets. The most of the bulk of exports of garments, for example, China exports close to $180 billion of garments to
Hmm.
US alone, apart from other European countries globally. And therefore, garments is a big part of exports bucket. Uh, and we are some of the beneficiaries of that. And yet, this headwind in trade deal, which impacts garment exports, is being kind of worked out by the companies that do these kind of exports. However, the biggest difference between Indian exporters of garments and Chinese exporters is that Indian exporters usually work also in the design front, as well as they work with more renowned brands. So the pricing pressure is less, but still the impact is there. Coming to Venezuela, it's very crucial because what we have to understand is that Venezuela plays a big role in oil supply, and usually Venezuela has remained away from any kind of trade tension or trade dispute because
Hmm.
and they have been a stable supplier of oil. I think what we have to consider is that what US does not want is a Chinese influence, which is very close to maritime, distance between US and Venezuela, and this
Hmm.
is an increasing flashpoint, and therefore crude oil, which is at kind of like pretty low right now, $60, there could be a very quick impact on crude prices if China or if Venezuela gets invaded by US. Is already building maritime pressures and um, border disputes. The airspace of Venezuela has been closed by US, which means there is imminent danger on the oil price, and that oil price feeds back through the inflation. So the MPC is due end of this week, and similarly, these geopolitical tensions could really ratchet up the input prices of oil. My guess is that RBI is still being inflation targeting central bank, with the
Hmm.
inflation rate of very very low compared to the target of 4%. They have a lot of room to cut. They might even cut 50 basis points instead of 25 basis points just to get done with it and see how the oil crisis, if at all, evolves, and then kind of let the US economy, the Indian economy, kind of trade deals happen. So yes,
Hmm.
I do expect a MPC trade rate cut. I do expect it to be larger than 25 basis points, but I think a 25 basis point is what the markets are generally pricing in, and it would be a surprise if RBI does not cut rates in this MPC meeting, which would further push up growth stocks, especially smaller cap stocks and micro cap stocks.
All right. Talking a little bit more about equities, foreign equities are back in focus right now. Do you think this is a good time for Indian investors to consider global markets as an investment?
Yeah, so I think US markets still are very interesting because there's some of the plays that are being played out in US market. There is no parallel of that in Indian market. To that extent, yes, they are still interesting. Valuation, they remain stretched, but valuations have always remained stretched for technology companies, and of course this is the buildup of a bubble, but it's nowhere near a bubble. So to that extent, for the foreseeable future, there is a lot of capex planned by technology companies. There's a lot of activity, and hence there is a play. But especially for Indian investors, the taxation is very unfriendly, right? So for a US, if you are doing direct US equity investments, you are supposed to pay tax on the peak value of that portfolio between a calendar year and pay it at marginal, maximum marginal rate, which means that if you're a big investor and you're in the high earning category, the amount of taxes you pay does not really make it very attractive compared to Indian investments. And similarly, for a US investor accessing Indian markets, they have to kind of a mutual fund in India or other forms of pool vehicle like an AIF. They are governed by something called Passive Investment Fund Company, which is PIFC. Where again, for a US person, which could be an NRI living in US investing in Indian mutual funds, for them also they are taxed on notional gains. So this remains a constraint, but given this constraint, I think where India could really outshine is for Indian investors investing in India. There is a case for foreign equity still, but it depends on how you structure it, whether you are how you route the money, at what level you get taxed. So not very tax efficient, but definitely investment opportunity wise interesting nonetheless. Depends on how you're able to access this, maybe through an Indian mutual fund or maybe through some other means, some other structure based in Mauritius, Cayman, and so on. So if you're not in that kind of planning category where you're taking advantage of these structures, you would rather kind of do it through the Indian equity only.
All right. Abhishek, let's also talk about other Asian markets. We have Korean markets, Chinese markets, and Japanese markets, and all of these have outperformed Indian markets this year. Could we expect a mean reversion in the near term if the FPIs or FDI inflows come back to India?
That has been the expectation, certainly for some months now. But usually the FPI and FBI flows are mean reverting. We have to understand some of it could be, with higher compliances on the ultimate beneficiary owner, the tripped money that probably Indians sent abroad, and then using that back, kind of using that again to invest in Indian equity, which is termed as FPI, that is getting washed out. Similarly, on the other hand, we do see these other Asian markets are outperforming India. So to that extent, the last couple of years have not seen a lot of inflow. In fact, they have seen outflows from Indian markets. So to that extent, I think definitely there is an opportunity for mean reversion, and definitely when they come back, they will come back in mass, right? So it will be a tide of FPI inflows. Rupee is at all-time low, which makes it very attractive for FPIs to come and invest. The reason is that, let's say an FPI that wants to invest in Indian equity, they will buy Indian rupee at 90. So for $1, they get 90 rupees. And then let's say that, basically the market gives you 10% return. So then that 90
Yeah.
rupees becomes 99 rupees. But if your rupee then moves to 84, for that 99 rupees, you could get more than 10% return, because 99 divided by 84 is more than 10%. So, that the extra bit is called your currency return, and that makes
Hmm.
also makes India very attractive in terms of global investors. So what usually happens is, I've worked in foreign sovereign funds and in pension funds. Somewhere in January, February, they make the allocation decisions of
Okay.
global equity. And what I do expect is that some of them might be smarter and already start to do it in December, but usually they work in a cadence where mid January they start to move their flows global macro wise, and next year early late December we might see the flows reverse quite dramatically, and that could provide further rally to the market, given Indian global macro is in a very good place.
Right. One more follow-up question, like you mentioned about the rupee being at all-time low. There's a lot of talk on the internet about like negativity has been attached to this thing where rupee has touched an all-time low. So it's bad in a general sense for people who do not understand commodities and currencies and markets that well. What would be your suggestion to those people how to look at it from a different perspective?
Yeah, so it is not the fault of the people who read it, right? Because we usually say rupee has weakened. and anything which
Hmm.
is weakened usually has a negative connotation, and that is
Yeah.
why people jump to the conclusion that a weakening rupee or a sliding rupee is a bad thing, and government has done something bad because of which rupee has slid from 65 to 90. In fact, it's the
Hmm.
opposite. The governments would die to have a weaker currency. US would die to have a weaker dollar. Japan would die to have a weaker yen. The reason being that if you, let's say you're Infosys, right, and you get a project from a US bank which says it's a $500 million project, so your revenue is $500 million, so you get X amount of rupees. Now if rupee becomes weaker, you get more rupees, and your costs are still in Indian rupees. So for an
Hmm.
exporting country like India, where we are exporting services and goods, uh, most of our listed markets, the net revenue is mostly export driven, at least more than 50%. It's actually a very good thing. It is in the interest of the country to have a weaker currency, because it does two things. It first does prevents Indian wealth from moving abroad, because you have to convert it to a weaker currency. So the country that is having a weak currency is able to control the outflow of money. So it is in the interest of the currency. Secondly, the second thing being the fact that when you have weaker currency, your exports are way more attractive. So, which means, imagine that India wants to be a defense manufacturer for the same kind of tank that or a jet, Tejas jet that India wants to sell to another country. It would be far cheaper to buy it in rupee than to buy it in euro, for example. So any kind of exports, be it in manufacturing, garments, be it in services like IT services, pharmaceuticals, generic pharmaceutical exports. These are all very good things for the companies, and it's bad for people who want to spend rupee and convert it to dollars or other currencies to travel outside. So travel outside becomes more expensive. Imports, which of things that we do not produce, become more expensive. The However, the biggest negative out of all this is oil, because we import oil, and if you have a weaker currency, the oil cost of oil goes up, and hence the inflation goes up. If inflation goes up, rates have to be tightened. If rates get tightened, then the currency also appreciates. So there is a mechanism, there's a linkage where a weaker rupee is good generally, but it's bad because it generally drives up inflation for local companies. And that is why, for the general population, who are the voters of the country, for them, as long as they see a benign inflation, they should not have any problems. In fact, they should rejoice on a weaker rupee. However, that is very difficult to manage, where you have great exports but weak inflation. And therefore, what we need to really understand is that when a country is trying to engineer growth, they will always try to target a weaker rupee. They would always try to make sure that the rupee remains competitive to other similar countries and economies which are also able to produce the same goods. So, therefore, while the narrative on the internet, I have seen many times that, oh, the rupee has weakened, oh, the rupee is going down. It's actually a good thing, right? Unless your local inflation goes up.
All right. Before we close, let's also talk about which sectors look strongest for the rest of the year to you, and where do you see near-term opportunities?
So one thing we have to remember, in the budget of Feb 2025, there was earmarked, 11 point lakh crores for government capex. The government has not kind of done anything close to that, right? So a lot of this capex will also be pushed through in the next 3 months, which will be in the form of infrastructure. First point. Second point is, for banks, the lending of infrastructure, the reserve ratio has been reduced from 4% to 1%, which means for the same capital, they can lend 3x more to infrastructure. So, therefore, the mix of the need to deploy capital in infrastructure, as well as the lower cost of borrowing and easier credit for infrastructure, makes infrastructure a very attractive sector. You can buy infrastructure ETF, you can buy infrastructure, largest infrastructure stocks as a way to play this. Similarly, weaker rupee also benefits services like IT services and pharmaceuticals. Between these, uh, IT services more a linear business to grow your revenue, to hire more. And with the advent of AI, there will be increased productivity gains where some of the tertiary jobs can be automated. But pharmaceutical is not that kind of a business where you're actually manufacturing the pills and the injections and the vials and so on. So there's a lot more operating leverage also available in pharmaceutical. So I think in my mind, local financials, basically housing finance and then NBFCs, as well as pharmaceuticals and infrastructure companies. This kind of mix of companies are sectors are likely to do well in the near term, depending on what I'm able to see going forward.
All right. Well, that's the end of our segment for today. Thank you so much, Abhishek, for taking out time and joining us today on ET Worldview, only on ET Markets live stream.
Thank you very much, and glad to be here and see you again soon.
Thank you so much. Thank you, everyone, for joining us today.